In 2020, we saw the stock market drop from an all-time high of 29,000 points down to 18,000 points, and over the course of the year, the stock market broke headlines by reaching record-breaking highs. Companies like Tesla and Apple reached unbelievable records and even went through stock splits. Many investors made a lot of money over the course of 2020, so I ask you, did you make money from the stock market last year? But more importantly, do you plan to make money from the stock market this year? 2021 is here, and you shouldn't let more opportunities go by. Everyone should know how to invest into the stock market. The goal of this video is to teach someone how to invest, and I promise you, by the end of this video, you will have a clear understanding of how you can invest into the stock market by following this simple step-by-step guide. Before we get to the guide, I have to state this video is for educational purposes only, and does not constitute any financial or investment advice of any kind. I am not registered to provide investment advice. If you are looking for financial or investment advice, please contact a registered professional. Alright, let's get into the guide. Step 1. Find a broker you like. A relationship with your broker is very similar to a relationship with your bank. You should find a broker you like because you could be with them for a long time. What is a broker? According to Investopedia, a broker is an individual or firm that acts as an intermediary between an investor and a securities exchange. Stockbrokers hold your investment accounts, similarly to how banks hold your checking and savings accounts. What are some common stockbrokers? You might be familiar with some stockbrokers, but maybe you didn't know what those companies did. Some common stockbrokers that you might have heard about are Fidelity Investments, Vanguard, TD Ameritrade, Merrill Edge, Charles Schwab, E-Trade, and Robinhood. There are many more brokers out there, but these are some of the more common names you might have run into. So what should you consider when choosing a broker? With the advancement of technology and brokerage firms becoming more and more accessible through the internet, the differences have decreased between brokerage firms, but there are still a few differences that should be considered before selecting a firm to do business with. Let's start off with what all popular brokerage firms have to offer. The best online brokerage firms offer investor-friendly resources. You can learn about the stock market, trends, portfolios, and much more with the resources offered by brokerage firms through their online portals. Overall, the differences are what will help you decide which brokerage firm to use. According to Bankrate.com, the three main factors to consider when comparing brokerage firms are price, broker resources, and strategy. Number 1. The price. As technology and competition have developed over the recent years, prices for trades have drastically fallen. Almost all brokerage firms will allow investors to trade stocks for $0 commission. Simply looking at the pricing of trades provided by brokerage firms will disqualify some firms if they charge a commission fee. Number 2. Broker resources. You'll also want to consider factors like the kind of advice and research tools that a broker provides, the quality of the digital trading app, and the ability to place trades quickly and reliably, among other details. Resources can be found on the website of each firm, but more often than not, similar information can be found through Google. Number 3. Strategy. The broker you really want will ultimately come down to your personal investment strategy, including how frequently you plan to trade and whether you're a beginner or are more experienced. Your broker can provide resources to help you craft and execute your investment strategy. Your strategy will evolve over time, and your broker should be able to accommodate your changing needs. To remain relevant and competitive in today's markets, brokerage firms have apps that can be used from any smartphone. From these apps, you can manage your portfolio, buy and sell stocks, and even read up on educational resources if provided by your firm. You can do just about everything from the app if you want to. Traditional brokerage firms such as Vanguard, Fidelity, and Merrill Edge have their own apps, but new companies have broken into the market too. There is a good chance a commercial for one of these companies has crossed your path. Companies such as Robinhood, Acorns, and Stash. Here is a small list of common brokers that you can consider if you want to do most of your investing through their respective apps. Overall, brokerage firms today are very similar to each other, and if you are not pleased with one, you can always take your money and switch to another firm. But it is helpful to pick one you like from the start. Do some research beforehand, and make sure you are satisfied with what your selected firm has to offer. Step 2. Open a brokerage account. The process to open a brokerage account is a little more stringent than opening up a bank account. According to the SEC's website, you will have to provide a fair amount of information to open a brokerage account. The information required is 1. Your name, 2. your social security number or taxpayer identification number. 3. Your home address. 4. A telephone number. 5. An email address. 6. A driver's license, passport information, or information from other government-issued identification. Number 7. Employment status and occupation. Number 8. Whether you are employed by a brokerage firm. Number 9. Annual income. Number 10. Net worth. Number 11. Investment objectives and risk tolerance. Overall, the list of information requirements is fairly straightforward, but the investment objectives and risk tolerance stand out amongst the list. Let's briefly go over investment objectives and risk tolerance. Investment objectives. Why are you investing? Ally Bank does a good job with going over a handful of common investment objectives. The investment objectives listed on the Ally Bank website are: Number 1. Income. Preservation of capital with a primary consideration on current income. Number 2. Balanced. Diversification of asset classes for an equal blend of income and long-term growth with the primary consideration being current income. Number 3. Growth and income. A balance between capital appreciation and current income with the primary consideration being capital appreciation. Number 4. Long-term growth with safety. Long-term capital appreciation with the relative safety of principal. Number 5. Long-term growth with greater risk. Long-term capital appreciation with greater risk. Number 6. Speculation. Maximum total return involving a higher degree of risk through investment in a broad spectrum of securities. Having a basic understanding of why you are choosing to invest your money can help you generate a basic starting plan. Your financial objectives will change as time passes. It's usually a good idea to go over your investment objectives a few times each year so your plan stays tailored to your life. Risk tolerance. How much can you afford to lose, and how aggressively are you willing to tackle the market? As a general rule of thumb, never invest more than you are willing to lose. Ideally, you don't want to lose any of your money, but your investments will fluctuate on a daily basis. For some people, it helps to not look at the stock market on a daily basis. Others choose to not become emotionally attached to their investments. And remember, you don't confirm a loss or gain until you sell. Now that your information is confirmed, it is time to select which account you'd like to open. There are two main accounts: cash accounts and margin accounts. For a cash account, an investor's ability to buy and sell securities will be determined on the amount of money they put into the account. On the other hand, margin accounts allow investors to borrow funds from their respective brokerage firm to purchase securities. The brokerage firm uses the securities in your margin account as collateral for the money it lends to you to purchase those securities, and you pay interest on the money you borrow. Margin accounts can offer you greater purchasing power, but also expose you to the potential for larger losses. Since this guide is tailored to beginners, it would be wise to open a cash account, and as this guide progresses forward, I will assume a cash account is being used. Step 3. Transfer money to your investment account. So now that you have opened your account, you have to give yourself purchasing power. And to do that, you have to link a bank account to your brokerage account. Linking your bank account can happen immediately or take a few business days. Just be aware that it may not be automatic. After your accounts are linked, you can transfer money from your bank account to the investment account. Once the money is transferred, you can start picking stocks. Also keep in mind the money may take a few business days to deduct from your bank account, so make sure you have sufficient funds in your bank account for the transfer. Step 4. Pick your stocks. Now that you have some purchasing power, you have to decide what you would like to buy. Some concepts to consider before proceeding are: Number 1. Invest in your circle of competence, also known as invest in what you know. Number 2. Consider your risk tolerance before investing. Number 3. Invest what you can afford to lose. Number 4. You are not buying into a stock that goes up or down on a daily basis. You are buying into a business. And number 5. Align your stock purchases with your investment objectives. When you first start, investing can be nerve-wracking. No one wants to make the wrong decision. But considering these 5 concepts will help give you more confidence in your investments. Before making your list of stocks, take some time to consider your investment goals and risk tolerance. Your risk tolerance will determine how aggressive of an investor you are. You might be an investor that is okay with losing all the money they invest, and your focus might be on smaller companies that might hit it big in the future. On the other hand, you could be someone who is more risk averse and is looking for a slow and steady climb for your portfolio. In this case, you might focus on putting a bulk of your money towards blue chip companies that pay dividends. I won't get too in-depth about blue chip companies and dividends in this video, but I will give you a quick summary of what they are. Blue chip companies are large-scale companies that have a national reputation for quality, reliability, and the ability to operate profitably in good and bad times. Think of McDonald's, Starbucks, Apple, Microsoft, Coca-Cola, and Pepsi. These companies are blue chip companies. They are considered to be safe bets. Since they are large companies, you won't get the opportunity to see massive growth, but they do pay dividends. A dividend is a sum of money paid regularly, most often quarterly, by a company to its shareholders out of its profits, sometimes reserves. A dividend portfolio can create passive income for an investor, but I will get into that in another video. Now it's time to make a list of stocks you'd like to purchase. It is highly recommended to invest in companies and market sectors that you understand. Investing in what you know will mitigate your risk, so choose your stocks carefully and take your time to craft your portfolio. When you are picking your stocks, you will come across ticker symbols. A ticker symbol is an assortment of characters that represent specific securities listed on a stock exchange. Examples of ticker symbols are AAPL for Apple, MSFT for Microsoft, FB for Facebook, T for AT&T, VZ for Verizon, MCD for McDonald's. You get the idea. When you search for a company stock, you will be shown the ticker symbol. When making your list of stocks, make sure to write down those ticker symbols. You will need them to search for each company on your list. Step 5. Decide how much money to put towards each stock. Now that you have a list of stocks you'd like to purchase, it is time to decide how much money you'd like to put towards each company. Overall, there are two driving factors here. Number 1, your purchasing power. Basically how much money you have to invest. Purchasing power will determine your budget. Your budget is the ceiling you have at that moment, until you transfer more money into your investment account. Number 2, how many shares of each company you'd like to purchase. Companies have different prices for their respective stocks, so it is up to you to decide how much you would like to invest into each company on your list. Also, this is very important, you do not have to purchase full shares. You can purchase fractional shares instead. The minimum purchase for fractional shares depends on your brokerage firm. Some firms require a minimum of $5, some require a minimum of $1, and some require a price equivalent to 0.001 of the stock price for the company you selected. When you purchase fractional shares, you will buy into the company at the current stock price. It might be beneficial to go over a quick example. Let's say you have $300 in your budget and want to purchase shares of Amazon. Let's assume Amazon's stock price is $3,000. If you purchase Amazon stock at the market price of $3,000 and use $300, you will receive a fractional share of 0.1 of Amazon. Thanks to fractional shares, you can continue investing into the companies on your list without having to tailor your investment strategy towards purchasing shares at full price. Step 6. Choose your order type. As a new investor, when it comes to purchasing stocks, there are two basic orders you can place. These orders are a market order and a limit order. It is important to understand the difference between these orders and what each one does. Different order types can save you money, and you can use order types to craft an investing plan for yourself. A market order is the most basic type of trade. It is based on speed. Your purchase doesn't have any contingencies that have to be met. With a market order, you are telling your broker that you are looking to purchase a certain amount of shares from a company or have a certain amount of money you would like to invest with the company, and don't necessarily care at what specified price. A market order will buy or sell near the current market price of a stock. I say near the market price because this is based on the ask and bid prices of a stock. Unlike a market order, a limit order is slower, but only because it asks for a specified price. Limit orders are often referred to as pending orders, because the order will remain pending until your specified price is met. With a limit order, you are telling your broker that you are not willing to pay more than the price you have selected. Your limit order will remain active until the markets close or if you decide to suspend your order. Remember, with a limit order, your order will only process if that specified price is met, but it is also possible for your order to execute at a lower price if the price of the stock drops below your designated price. As you build experience with the stock market, there are other market orders you can consider using. These market orders are buy stop orders, stop loss orders, and trailing market orders. I won't cover those market orders in this video since this is a beginner's guide, but if you would like me to make a video explaining these kinds of orders, please leave a comment below asking for the video. Step 7. Place your order and start buying stocks. Once you make it through steps 1 through 6, you are officially ready to buy stocks. Just place your order and your money will be converted to shares as soon as your order is filled. Crack open a champagne bottle and celebrate, you just became a business owner. To make sure everyone that watches this video can confidently purchase stocks, I will show how to go through steps 4 through 7. I have to remind you this section is strictly for educational purposes only. I am not sponsored by any company displayed in this section, and I am not endorsing any company or their stocks. After you transfer money to your investment account and you are ready to purchase stocks, you will see a screen similar to this one. This screen may vary depending on which broker you decide to go with, but overall the information should be the same. At the top, the section labeled symbol is where you can type in a ticker symbol. For this example, I am going to use PepsiCo. The ticker symbol for PepsiCo is PEP. Once PEP is in the search bar, it shows the last price, bid price, and ask price of the stock. Let's say I want to purchase 5 shares of PepsiCo stock. I have to select buy as my action, shares as my quantity type, and the quantity I want is 5. An estimated cost is displayed beneath the quantity. In this case, it says $694.45. The estimated cost is equivalent to the quantity times the ask price. Instead of selecting a quantity of shares to purchase, I can specify a dollar amount I want to invest. On the quantity type, I can select dollars. For this example, I put $500 and the estimated shares came out to 3.599. After deciding how many shares to purchase, the next step is to choose an order type. If I want my shares as soon as possible, I can keep market order selected, but if I want to purchase my shares at a lower price, I can select limit order. If limit order is selected, a limit price section will be displayed, and for this example, I use $135. The estimated cost of purchasing 5 shares is now $675. Keep in mind that since you are specifying a price in a limit order, your quantity type will default to shares. All that's left is to hit the preview order button and confirm my purchase. Overall, that is the process on how to invest into the stock market. I hope at this point you're thinking, wow, this is much easier than you initially anticipated. As you begin to embark on your investing journey, I'd like to remind you, even if you only own 1 share of a company, you are still a partial owner. You won't be on the board of directors anytime soon with only 1 share, but you will participate in the financial success of the company, and you should be proud of yourself. You have officially taken a big step towards your financial goals. Please remember, the goal here is to invest intelligently and mitigate your risk. Over the long haul, you want to come out ahead. Paul Samuelson, a former American economist, had a very useful quote. Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. That quote might be worth its weight in gold if you remember it throughout your investing journey. Remember to do your own research, mitigate FOMO, and don't purchase shares in a company just because a friend or a headline tells you it's a good idea. You have your own path, your own plan, and your own goals. Remember that every time you invest. I wish you good luck, and I hope you are very successful throughout your investing career. If you found this video helpful, please consider leaving a like and subscribing for more content. If there are any topics you would like me to discuss or explain in a video, please leave your idea in a comment below. Thanks for watching, have a great day, and I'll see you in the next video.